Now, sometimes people buy products or items with the agreement to pay instrumentally or to pay gradually over a period of time. So in this class, we're looking at that sort of arrangement where you have, a seller giving a product to a buyer, and then there's an agreement to pay gradually. In accounting, we refer to that arrangement as hire purchase. So today, we're looking at hire purchase account. So what I'm trying to say here is that there is an arrangement where there's an exchange of what? An item. And then one party is saying, go with the item, pay me over a particular period of time. But there's going to be an interest for that arrangement. So we call that hire purchase. So the account that we prepare to capture such transaction is what we call the hire purchase account. Now there are perspectives, the buyer's perspective and the seller's perspective. Okay, in practical terms, you can have a third party, which is like the financier. So in this volume, we're not looking at the third party's perspective. We're looking at a scenario where the seller is the same thing as the financier. So we're looking at just two perspectives in this volume, which is the buyer's perspective of the hire purchase arrangement and then the seller's perspective of the hire purchase arrangement. So what we're saying is that the asset has been purchased on credit from the vendor. The vendor is the seller or a finance house, depending if the finance house is the one that is selling the product as well, or even a bank. Okay, but remember I said that we are looking at just two perspectives, the buyer and the seller. The seller is also assumed to be the financier in this volume. So what we're saying is that in the buyer's perspective, there is a record for the asset, which is the item of hire purchase. There's a record for the vendor, which is the seller in the book of the buyer. There's an interest charge, okay, which is the additional amount you're paying because you're paying over a long period of time. And then there is a depreciation, because most times hire purchase is used to finance assets, and then because it's an asset, you have to depreciate. So the hire purchase asset account is the same asset, but because of the fact that there's an arrangement to pay over a particular period of time, we should be able to capture the real items that concerns the hire purchase asset account. So basically, what we bring into this account is the cash price of the asset. What I mean by cash price is the normal price of the asset if you are not going into hire purchase agreement. For instance, you're buying an item for say 1 million. Okay, but if you're going to hire purchase, you're paying 1.5 million. That 1 million is the normal selling price. Okay, so that is what we call the cash price. So the amount that goes to the hire purchase asset account is the cash price of the asset upon delivery and recognition by the buyer. Now this is what I'm saying. Your, let's say, equipment account is an asset. Your asset have debit balances. Okay, I have actually taught classes on asset, liabilities, income, and expenses. Okay, so basically we can say hire purchase equipment account. It can be anything. It can be hire purchase motor vehicle, hire purchase plant and machinery, whatever item that is asset like. So let's say 1st of January 2019, we bought hire purchase equipment from the vendor. So what do? We debit the asset account with the amount. Is that not so? And then we credit the vendor. So we have hire purchase vendor account. Okay, so that means that normally we carry cost and asset at their cost values. So the depreciation on the asset goes where? The provision for depreciation. So basically this is the equipment hire purchase equipment account. We have the amount, that's the cash price, debited to the account, so that you have the cost being carried over the estimated useful life. Now from the buyer's perspective, remember he is buying from someone on credit, so that is the vendor. In your normal double entry, if you're buying on credit, what do? You debit the asset item and credit the vendor. So it's the same thing here. Hire purchase vendor account, that's the person that we're buying from, as the seller in this arrangement. So what do? You are crediting him for the amount you are owing him. Is that not so? So since we are debiting the asset account, the hire purchase asset account with the cash price, which is the normal price, we credit the vendor with the same normal price. Okay, that is what we're talking about here. Like I said, if for instance the asset normal price is 1.1 million, hire purchase agreement is what 1. What that means you're paying interest of 500,000. Okay, the 1 million is the normal price, that's the cash price. So debit asset account with the cash price, credit the what? Hire purchase vendor account with the what? With the cash price as well. So this is an example of what I'm saying. This is the hire purchase financiers or vendor account, okay? So you can as well say hire purchase seller account, depending on what you want to call it. Or you say hire purchase vendor account, whatever name the vendor bears, okay? If it is maybe Babes Limited, put Babes Limited there. So what are we saying here? This is the date, 1st of January, the hire purchase equipment. We bought on credit for him, so we're crediting him to show that what we are owing him from the buyer's perspective. Now, any interest that he's charging us for the hire purchase agreement, that will mean that we are owing the total amount, which is the cost of the equipment at normal price plus the what interest. So you credit him with that amount. That's what you have here. So as we're paying him gradually, we'll be debiting him. You can see how it is going here. As we're paying him gradually, we're debiting him. So whatever balance is remaining at the end of the what period, will balance, it will be the carry down, and then goes to the what following period as balance brought what down. So we have mentioned cash price. So let's quickly explain that terminology. I already explained that the price of the hire purchase item, okay, when you are not paying installment is what we call the cash price. For what I'm saying is that if you are buying without what paying over a long period of time, what would have been the normal selling price? That would mean by cash price. Okay, like I said, if the item is 1 million, normally if you're paying immediately, it's 1 million, that's the selling price. Okay, that will call the cash price. But if you're paying over a period of time, then you're paying the higher purchase what price, which is cash price plus the interest. So higher purchase interest account is the account that captures what the additional amount added to the cash price. What I'm saying is we already established that 1 million is the cost of the item. Cash price of the item. So higher purchase price will say is 1.5 million. So that means you have 500,000 as an interest. So the account that captures it from the buyer's perspective is the higher purchase interest account. And then what happens is that as we are gradually paying off the vendor, we are also gradually taking off this amount to the profit and loss account. So whatever balance that is left, will capitalize it. Okay, so you should also be able to refer to your IAS 23, which is borrowing cost. Okay, you can also look at initial cost of an asset. That's IAS 16, property, plant and equipment. And you can also look at impairment of asset on your own, IAS 36. So basically, on your own, read all that and then get some information. So this is the hire purchase interest account. Like I said, the additional amount on the equipment, okay, is what you're bringing. So as I'm saying, you have already credited your vendor with the interest on the hire purchase equipment. So you debit your hire purchase interest account here. So you gradually write it off to your profit and loss. As a matter of fact, the idea is that you are paying over a period of time. So as you reduce the vendor credit, okay, so within the period, the installment that falls within the period of reporting, you also calculate the interest that has been paid technically based on the installment, and then take it out of the interest. So whatever balance you have, you capitalize at the end of the period. So what I'm saying is that if, for instance, the interest is 500,000, and then you're paying, say the vendor credit, which is the higher purchase amount, okay, you're paying it over, let's say, 4 installments. So basically, you're going to pay the 500,000 to over 4 installments. So if it is 2 installments that fall within the period, that aspect is written off to the profit and loss account. So you can capture the unpaid balance of the interest. So we just mentioned higher purchase interest. What I'm saying is the additional amount that you add to the cash price of the item. I already explained that if we assume that the cost of the item is 1 million, if you're paying without going into higher purchase arrangement. So by the time you say higher purchase arrangement, it turns to 1.5 million. That means the 500,000 on it is the higher purchase interest. Remember, the 1 million is the cash price. So that additional amount, okay, is what we call the higher purchase interest. So we say provision for depreciation. So what we're saying here is that since it's an asset that you're buying on hire purchase, you also have to depreciate the asset over a specific period of time. So that's based on the depreciation policy of the organization. So it can be straight line, it can be reducing balancing, it can be revaluation, it can be unit of any method adopted by the organization is what you use to depreciate the asset. So this is what it looks like. It's a normal provision for depreciation account. Okay, we've already discussed what depreciation is. You can go to depreciation class to understand what depreciation means and how to record depreciation. It's the same thing. Okay, so if at the end of the year, let's say 2019, okay, the asset depreciated value is say 1 million or 200,000. So that's what you're bringing for that year. Okay, you take it to profit and loss account. So you balance because you're going to accumulate it. Remember, the cost of the asset remains the same over the estimated useful life. So where you take the depreciation to is what we call the provision for depreciation or the accumulated depreciation account. So that's where you accumulate the gradual reduction. So if the asset is for 4 years, so the gradual reduction is going to be accumulated into the a provision for depreciation account or the accumulated depreciation account. So at the end of the last year, you can now merge the two together to understand the scrap value of the asset. So basically, you have P&L, balance carried down, becomes balance brought down the following year. So whatever you're charging for that year again increases the provision, it becomes balance brought down the next year. So that's basically how you do the accumulated depreciation. Okay, this is a question. This is Dada Limited purchased equipment from Etor Limited on a hire purchase agreement on February 2019. The cash price of the equipment were agreed at 1.5 million and was bought on hire purchase price of 2 million. Okay, so we have the equipment to be agreed to be 1.5 million cash price, but the hire purchase price was 2 million. So an initial deposit of 500,000 was agreed and paid for. It was agreed that a quarterly installment of 250,000 should be paid by Dada Limited. All installments were paid as at when due. Dada Limited prepares account to 31st December every year. It also depreciates its asset at 25% straight line basis. You're required to prepare the necessary ledger to show the hire purchase transaction in Dada Limited's book. So it's your normal debit and credit. So let's go. This is the hire purchase equipment. So as I'm saying, so we have the hire purchase equipment here. Normally, if you buy an equipment, what do? Debit the equipment, credit the bank that you're paying in cash. But here is on credit. So you're debiting the asset account and crediting whoever that you're buying from, which is Etor Limited. That's why you have 1st of January, Etor Limited. That's the seller. You debit your equipment, you credit the seller. Okay? That's what you're doing here. So hire purchase financier or vendor, which is Etor Limited. You have debited hire purchase equipment. So what do? You credit the vendor 1.5 million. Now they said there is what we call the hire purchase price, which is 2 million. So if the cash price is 1.5 million and hire purchase price is 2, that means there is a 500,000 interest. So what do? You debit the vendor with it. Is it 500,000? Okay. So what do? This is a debit the financer, which is the vendor 500,000, and credit credit the financier with 500,000 and debit the interest, which is it. Look at it here. Hire purchase interest, 1st of January 2019. Okay, you have 500,000. So you have the hire purchase interest account here debited with 500,000, which is the interest on the hire purchase item. So what happens now? They now said that it was agreed and paid for that. It was agreed that the quarter installment of 250,000 should be paid by Dada Limited. But there was an initial deposit, and initial deposit of 500,000 was agreed. That means before the installment begins, you pay an initial deposit of 500,000. So if you're paying the vendor, you're reducing the amount, which is 1st of January 2019. You're paying through your bank, so you debit the vendor 500,000. That's a reduction. Okay. So it means that they now say that they say it was agreed, and they say it was agreed that a quarterly installment of 250,000 should be paid by Dada Limited. Quarterly. What's quarter? Quarter is 3 months, right? So quarter is 3 months. So if you start by 1st of January, so by 31st of March, you should pay the first quarter. So that's what you do. So the remaining amount The remaining amount, which is how much? 1.5 million. If you divide it by what? How many quarter? How many months? We have like 3 months in one quarter. Okay. So basically, if you divide 1.5 by 3, you get 6 times. You get 6 times. Okay. So basically, we're saying that in every quarter, you pay how much? 250,000 naira. Okay, so 6 times you pay 250,000 naira. So as I was saying, if you divide 1.5 million by 250,000, which is per quarter, you have 6 installments. Okay, and how many quarters do you have in a year? Okay, to pay. Okay, so you have the first quarter, the second quarter, third quarter, fourth quarter. That means you're going to pay 4 installments in 2019. So that means you have 31st March, you pay 250,000. 31st June, you pay 250,000. 31st September, you pay 250,000. 31st December, you pay 250,000. Okay, so the balance remaining will be what? 500,000, which you're going to carry to the what? Following year. So here we have the hire purchase interest account. The hire purchase interest account here is what showing the additional amount paid on the what? On the transaction, which is the hire purchase item. So basically, we have what? The hire purchase interest. 1st January 2019, this is the hire purchase vendor interest, okay, that we paid. We credited the vendor. We credited the vendor with 500,000, so we're going to debit the hire purchase interest, 500,000. Okay. Now remember that in this year of reporting, we have established that we are paying the total balance of 1.5 million after the initial deposit. We're paying the remaining 1.5 million over 6 installments, and in 1 year we have 4 installments. So the same way we are going to pay the interest over 6 installments, but in the year of reporting we have 4 installments. So basically, if you divide 500,000 by 6 installments, you have about 83,333. So if you now if you multiply by 4 installments in the year, that means what you're writing off as the interest for the year is 3333. Okay, so you can just try that. Divide 500,000 by 6, which is 6 installments. That will give you the value per installment. Okay, and then you now multiply by 4 installments that you're going to have in a year, which is from 31st of March to 31st of December. So we have how many? We have 33333, which is the price per installment times how many installments? 4 installments in a year. So that will be 33333, which is what you're taking to a profit and loss account for 2019. So you use it to reduce your interest, to know the balance of interest that you're carrying to the following year. That's what you're doing here. Okay, the next one is provision for depreciation. You're writing off the assets gradually. So what do you have? Provision for depreciation hire purchase account. Okay, the asset is 1.5. Remember, so they say you should write it off 25% straight line. That's 4 years. So if you divide 1.5 by 4, you have 375,000. So the first year, which is 2019, you write off 375,000 to the P&L as depreciation. Okay, it accumulates and then brought forward to 2020. You write off another 375 in the second year, gradually like that. So the balance sheet extract, which is equipment, net depreciation is 1,125,000. Okay, the cost of the asset is 1.5. Take out depreciation 375 for the year, you have 1,125. And then you have the interest cost capitalized, which is 1,666.7. Remember, I told you that it is more like borrowing cost, and then according to IAS 23, we capitalize the cost of borrowing. So this is the seller's perspective. So basically, from the seller's perspective, the item is an inventory. It's like he is buying and selling. So you're going to be looking at it from that perspective. So the item is an inventory, okay, that he has bought from a supplier as well. So there's a cost of the goods. Okay, the cost of goods here is the cost of the item, not the cash price. The cash price is the normal selling price. Okay, so basically the seller here is more like what? Someone who is going to be trading to get gross profit on the what? Inventory item. Hire purchase inventory account. That is an account that takes the stock of the hire purchase items. Okay, at the cost of the goods, which is the cost that the seller bought it from his own supply. Remember, we are now dealing with the seller's perspective. Okay, so this is what it looks like. You can see hire purchase inventory. Your inventory is an asset. If you have any opening balance, you bring it forward, balance brought forward. Anyone that you have sold at the cost price, take it to your trading account, basically. So I just mentioned cost of goods sold, also called cost price. That's the cost at which the seller got it from his own what? Supplier. Now the debtor account is what? It's more like the buyer now. Remember, this guy is selling. So he is selling to what? The buyer. So the buyer is like a debtor because the buyer is going to be owing the business. So he's going to debit the buyer with the what? The cash price of the hire purchase item and whatever interest he is charging for the hire purchase agreement. Now this is how it looks like. You have hire purchase debtors. Okay, so the hire purchase sales, okay, which is what? The cash price of the hire purchase item. Remember, it's the seller's perspective. So you sell to the debtor, you debit this what? The debtor. So we have a debit balance and the interest you're charging the debtor. Okay, and then as the debtor pays, you credit him to reduce it. Whatever balance is left unpaid, you carry to the what? Following year. This is double entry, debit and credit. So if you already followed my class on double entry, this should not be an issue. So this is the sale account that what takes record of the what? The hire purchase item sold. Okay, so basically the corresponding entry from the debtor account for the sales made on the hire purchase item is entered in the what? Hire purchase sales account. So this is what it looks like. You can see hire purchase debtor. Okay, you credit the hire purchase sales account from the debtor, and then whatever you have transferred to what? Your trading account. Your sales is like your turnover, it goes to your trading account. That's why you're transferring it here. So hire purchase interest account. Okay, the agreed interest on the hire purchase agreement is what goes to the hire purchase interest account here. Basically you're increasing what the debtor is owing by this interest. So to the seller, it's an income. You have to understand that. So this is what it looks like. You can see that you have the hire purchase debtor. You have debited the hire purchase debtor with the what? Interest on the hire purchase item. So you bring it to the interest account here as an income. Credit. Remember your double entry principle for incomes. You credit. So you credit here and transfer to a trading account. So these are some terminologies. Big ticket items. So when you have items that are significantly high in higher purchase interest and higher purchase value, we refer to them as BTIs, big ticket items. Okay, so usually their payment spans over a long period of time. But when you have small small interest and small higher purchase values, and payment is usually over a short period of time, we refer to it as small ticket items. Okay, so this is the same question, but now we're looking at it from the seller's perspective. So we still have Dada Limited purchase document from Untitled Limited on hire purchase agreement on February. The cash price of the document was agreed to be 1.5 million and then was bought on hire purchase price of 2 million. An initial deposit of 500,000 was agreed and paid for. It was also agreed that the quarterly installment of 250,000 naira should be paid by Dada Limited. All installments were paid as at when due. The Dada Limited prepares his account at the festival every year. It also depreciates its what? Asset at 25% single line statement. So this is for Dada Limited. But I'm not saying that you're required to prepare the necessary ledger to show the higher purchase transaction in Debtor Limited's what? Book, assuming that cost of goods is what? 1.4 million. So basically, Debtor is the seller here. That's the vendor. So we're looking at it from his own perspective. He is selling. So he is selling. So what do? We have the higher purchase inventory account. 1st January, balance brought forward. Let's assume that's the only item. Okay, 1.4 million is the cost. That's what Debtor bought as the vendor, which is Debtor Limited, bought it from his. So like I said, this is just a double entry, basically. So we have our purchase inventory account now. This is the debit and asset are debited. Balance brought forward. This is the cost of the item purchased by Debtor Limited, which is the vendor. Okay, he is now selling. So sorry, he does the purchasing. Trading, our purchase trading account is taken to trading account, as a cost of what? sale. No, we're looking at it from the word seller's perspective. So that's what you have here, closing the account. And we have the debtor, which is Dada Limited. Okay, he sold to them. You're going to debit the person with the cash price of the item, okay, which is the normal selling price, and then the interest you're charging. That's what you're having here. The higher purchase sales 1.5 million, the higher purchase interest 500,000. So the Dada Limited paid initial a deposit of 500,000. That reduces it to 500,000 here. Then we have what the installmental payment. I already explained that. Okay, we are paying 250 per quarter. So that means the seller is receiving 250 per quarter. So if you divide 1.5 by 250, you have 6 quarters. So in 1 year, you have 4 installments paid. So we have 31st of March, 31st of July, June, 30th of June, basically. Then we have September, we have December. So these are the banks. Okay, so pardon my days here. So we have the bank here for March, for June, for September, for December. So we have 250, 252. So we have 4 quarters in what? In the year. So basically, at the end of 2019, the balance remaining unpaid will be 500,000, which will be carried to the following year. So we have the hire purchase sales account showing the sales made. So we have 1st of January hire purchase debtor. Okay. Remember, you sold to the debtor, which is Dada Limited on credit. So you debited the debtor and then you credit your sales. So this is going to your trading account, 1.5 million. So the interest, hire purchase interest account, you also debited the debtor with 500,000 as the interest, which is the hire purchase value, which is cash price plus the word interest. So you have that to be what? 500,000 taken to where? The trading account as well. So there's the trading account now. Hire purchase trading extracts. Your turnover, which is your sales, is 1.5 million. Your cost of the goods sold is 1.4 million. Remember, they said what? Look at it, you're required to pay next ledger to show the higher purchase transaction in Debtor Limited's book, assuming cost of goods is what? 1.4 million. I already explained that cost price is the price that the vendor got it from his own supplier. So that's the cost of goods in 1.4 million. So different is what? 100,000 naira profit. There's an other income, which is the interest you're charging for the what? Higher purchase agreement. For the hire purchase agreement. So that is the what? 500,000 that you're bringing here. So basically your gross income for the year is 600,000. Arguments can come in relation to what? Maybe unrealized profit and all that, but we must also refer to the recognition of income on sale of goods item, where your responsibility in this case has been transferred to the buyer. So basically the revenue has been what? Has been earned because the debtor has been debited and then he has agreed to pay in full the higher purchase value. So we can as well refer to IS 18, that's revenue recognition for sale of goods, for understanding in this regard. Although we can have issues where the full ownership is there, but there are some responsibilities that are also on the vendor, but that is not what we're doing in this volume. So here we are assuming that it has been agreed that it will be settled in full. So here we assume that. So we assume that the revenue has been earned, which is the interest on the higher purchase interest. So basically, the gross income on that transaction is 600,000. Gross profit on the normal sales 100,000. Income for the interest on higher purchase agreement is 500,000. That's 600,000 from the seller's perspective. Class, we have discussed hire purchase accounts. Okay, we've been able to look at various terminologies and various accounts that we prepare to record hire purchase transactions from the buyer's perspective and from the seller's perspective. I already explained that we can as well have the third party, which we have in recent practices, where you have the buyer, you have the seller, and then you have the financier as the bank or the financer. But in this scenario, we looked at the seller, which is the vendor, as the financier as well. So he owns the product and is entering a hire purchase agreement. That's the instance we looked in this volume. So if you have questions, you can reach me on 08136506356 or send me an email, jeremiah.doso@gmail.com. You can drop questions in the comment section. I'll be there to reply you with the right answers. I have a Facebook page, Jeremiah Doso, that's JAD. You can like it to follow me to get updates on topical classes that we publish from time to time, even as we walk towards the second volume that has quite a lot of interesting topics and other aspects, to cover more advanced level. Thank you.